Welcome back to Boni's Life, the channel where we cut through the noise and give you the unvarnished truth about the financial markets. Today, we are diving headfirst into the crypto market's latest bloodbath. What we've witnessed in the last 24 hours is nothing short of a seismic shock to the system, a red October that has left even the most seasoned traders reeling. We're talking about a market painted in crimson, with billions of dollars in leverage positions wiped out in the blink of an eye. The question on everyone's mind is, why? What is driving this massive sell-off, and more importantly, what comes next? Is this the beginning of a prolonged bear market or a much-needed correction before the next leg up? In this episode, we're going to dissect the anatomy of this crash with surgical precision. We'll explore the powerful macroeconomic forces at play, from the escalating US-China trade war to the Federal Reserve's next move. We'll dive deep into the on-chain data and technical analysis to identify the key levels that will determine the market's fate in the next 24 hours. And as always, I'll provide you with actionable trading scenarios and strategies to help you navigate this treacherous market. This is not the time for fear or panic. It's the time for clarity, for strategy, and for a deep understanding of the forces that are shaping our financial future. So buckle up, because we're about to embark on a deep dive into the heart of the crypto market. Let's start by looking at the raw, unfiltered numbers, because they paint a stark picture of the carnage that has unfolded. The total cryptocurrency market capitalization has plummeted by 3.1% in the last 24 hours, now standing at a precarious $3.674 trillion. That's over $115 billion in value erased from the market in a single day. To put this in perspective, that's more than the entire market capitalization of major corporations. The 24-hour trading volume has surged to a massive $278.15 billion, a clear indicator of the panic selling that has gripped the market. This volume spike is significant because it shows that this isn't just a low liquidity flash crash. This is genuine selling pressure from both retail and institutional investors. Now, let's break down the performance of the major players in this market massacre. Bitcoin, the undisputed king of crypto, has taken a significant hit, down 4.0% to a current price of $105,929. But if we zoom out to the 7-day chart, the picture becomes even more concerning. Bitcoin is down a massive 12.0% over the past week, erasing weeks of gains and putting the entire bull market narrative into question. The 24-hour trading volume for Bitcoin alone has reached $105.90 billion, up nearly 48% from the previous day. This massive volume increase during a price decline is a textbook sign of distribution, where large holders are offloading their positions onto retail investors. Ethereum, the engine of the decentralized finance ecosystem and the second largest cryptocurrency by market cap, has fared even worse. It's down 6.2% in the last 24 hours to $3,762.59 and down a staggering 12.9% over the past 7 days. What's particularly concerning about Ethereum's price action is that it has broken below the critical psychological level of $4,000. And the pain doesn't stop there. BNB, the native token of the Binance ecosystem, is down a staggering 9.5% to $1,001.39. Solana, which has been one of the best performing Layer 1 blockchains this year, has been hit with a 7.27% loss, now trading at $178.94. XRP is down 5.92% to $2.27. The altcoin market in particular has been a sea of red, with many projects seeing double-digit losses. Asta has fallen 18.6%, and numerous other tokens have dropped between 10% and 20% in the past 24 hours. This is a classic flight to safety, with capital flowing out of riskier altcoins and into the relative stability of Bitcoin, as evidenced by the rise in Bitcoin dominance to 57.5%. But the most dramatic and devastating story of the past 24 hours is the liquidation cascade that has wiped out leverage traders across the board. A jaw-dropping $1.2 billion in leveraged positions have been liquidated in the past 24 hours, representing a 135.21% increase from the previous period. This is not just a brutal reminder of the dangers of trading with high leverage in a volatile market, it's an absolute massacre. To break this down further, Bitcoin liquidations accounted for $329.06 million in longs and $123.79 million in shorts. Ethereum saw $201.46 million in long liquidations and $79.58 million in short liquidations. Solana experienced $70.17 million in long liquidations. The Carnage has affected 293,191 traders who have been completely wiped out. The majority of these liquidations, approximately 74.7%, were long positions, meaning that traders who were betting on a price increase were mercilessly squeezed out of their positions. This forced selling has created a vicious downward spiral, a cascading effect where liquidations trigger more selling, which in turn triggers more liquidations. The largest single liquidation order was a massive 20.42 million ETH USD position on Hyperliquid. The Fear and Greed Index, which measures market sentiment on a scale from 0 to 100, remains firmly in the extreme fear territory. We haven't seen levels this low in months. This is the kind of market where fortunes are made and lost in the blink of an eye, where discipline and risk management separate the survivors from the casualties. So, what is the driving force behind this market meltdown? The answer lies in a perfect storm of macroeconomic and geopolitical events that have created a tidal wave of fear and uncertainty. At the forefront of this storm is the escalating trade war between the United States and China. On October 15th, President Donald Trump confirmed that the US is now in a full-blown trade war with China, threatening to impose 100% tariffs on all Chinese imports. This is not just a political headline. It's a direct threat to the global economic order and the flow of capital across borders. Tariffs act as a stealth tax on consumers and businesses, driving up the cost of imported goods and stoking inflation. When inflation rises, central banks are forced to keep interest rates higher for longer to combat it. Higher interest rates drain liquidity from the financial system, making it more expensive to borrow money and reducing the appetite for risk assets like cryptocurrencies. We saw this exact scenario play out in 2018 when the last trade war pushed Bitcoin below $6,000 and triggered a prolonged bear market. The impact of this trade war extends beyond just tariffs. It creates uncertainty about global supply chains, corporate earnings, and economic growth. When businesses don't know what the regulatory and trade environment will look like in 6 months, they pull back on investment and hiring. This slows down economic activity and creates a risk-off environment where investors seek safety rather than returns. The crypto market, which is still largely driven by risk appetite and liquidity, is particularly vulnerable to these macroeconomic headwinds. The second major factor weighing on the crypto market is the uncertainty surrounding the Federal Reserve's monetary policy. We're getting conflicting signals from Fed officials, and this ambiguity is creating paralysis in the market. On one hand, Governor Chris Waller has called for an October rate cut, citing concerns about economic growth and the need to support the labor market. On the other hand, the inflationary pressures from the trade war may force the Fed to maintain its hawkish stance and keep rates higher for longer. Fed Chair Jerome Powell has indicated that the Fed may soon wind down its quantitative tightening program, which would be a positive development for risk assets. However, the timing and pace of this pivot remain uncertain. This uncertainty is creating a paralysis in the market as investors are unsure of the future direction of interest rates and liquidity. A dovish Fed pivot with rate cuts and an end to quantitative tightening would be a powerful tailwind for crypto. However, a hawkish Fed that maintains high rates to combat inflation could send us into a deep and prolonged bear market. Adding to the bearish sentiment are the significant outflows from Bitcoin spot ETFs. Recent data shows sustained net outflows from these institutional products, with major funds like ARKB, BITB, and GBTC seeing significant withdrawals. This is a massive reversal from the inflows we saw earlier this year, when Bitcoin ETFs were attracting billions of dollars in capital. This is a clear sign that institutional investors are de-risking their portfolios and reducing their exposure to crypto. When institutions pull money out of the market, it removes a significant source of buying pressure and creates a headwind for prices. However, it's not all doom and gloom on the institutional front. We're also seeing some smart money taking advantage of the dip. Bitmine Immersion Technologies, for example, recently purchased another 104,336 ETH for $417 million, bringing their total Ethereum holdings to over $9.3 billion in market value. Finally, we have the looming specter of regulation. The G20's risk watchdog has warned of significant gaps in global crypto regulations, highlighting the need for coordinated international oversight. Fed Governor Michael Barr has been speaking about the need for stablecoin regulation at the 2025 DC FinTech Week, outlining potential risks and pitfalls that need to be addressed. While regulation is ultimately a good thing for the long-term health and legitimacy of the market, in the short term, it creates uncertainty and fear. The market hates uncertainty, and the current regulatory landscape is a minefield of potential risks. Will stablecoins face stricter reserve requirements? Will DeFi protocols be subject to securities laws? Will exchanges face increased compliance burdens? These questions remain unanswered, and until we get clarity, they will continue to weigh on market sentiment. Now, let's turn to the charts, because they are telling a story of their own. And right now, that story is a bearish one. Bitcoin has broken below the critical support level of $108,000 and is now trading at $105,929, dangerously close to testing the 200-day exponential moving average EMA, which sits around the $102,000 to $105,000 level. This is a major technical level that has historically acted as a line in the sand between bull and bear markets. Throughout Bitcoin's history, the 200-day EMA has been a reliable indicator of long-term trend direction. When Bitcoin trades above it, the market is in a bull phase. When it trades below it, the market is in a bear phase. A break below the 200-day EMA would be a very ugly turn of events for Bitcoin, likely triggering algorithmic selling and a new wave of panic. The immediate resistance for Bitcoin is at $110,000. Above that, we have resistance at $112,000 and $115,000. The technical indicators are also flashing bearish signals across the board. Ethereum's chart is even more concerning from a technical perspective. It has broken below the key psychological level of $4,000 and is now trading at $3,762.59. The weekly MACD has just flashed a bearish cross, which is a technical signal that has historically preceded major corrections. This is not a signal to be taken lightly. In mid-2024, when the weekly MACD flashed a bearish cross, Ethereum dropped 46% over the following weeks. In the first quarter of 2025, the same signal was followed by a 60% drop. If history repeats itself, Ethereum could be in for a lot more pain in the coming weeks and months. The key support level to watch for Ethereum is $3,750, which is the current trading range. A break below that level would open the door to a deeper correction towards $3,650 and even $3,550. Adding to the bearish technical picture is the retail sentiment data. According to Highblock Capital, retail traders are holding 90% of their Ethereum positions as longs, putting them in the 90th percentile of bullish positioning. This is an extreme level of optimism that is not supported by the price action. What's particularly interesting is that this metric has a negative correlation of minus 0.86 with price movement, meaning that when retail traders are this overwhelmingly bullish, the market tends to move in the opposite direction. This is a classic contrarian indicator, suggesting that we may be setting up for a bull trap where retail traders get squeezed out of their long positions. The altcoin market is in a state of complete capitulation. With Bitcoin dominance on the rise to 57.5%, capital is fleeing from altcoins and into the relative stability of Bitcoin. The funding rates for most altcoins are extremely negative, indicating that traders are heavily shorting them. This is a sign of extreme fear, but it also creates the potential for a massive short squeeze if the market sentiment turns. If we get a positive catalyst, all of these shorts would need to cover their positions, creating a buying frenzy that could send prices sharply higher. However, in the current environment, that seems like a low probability scenario. So, what can we expect in the next 24 hours? Based on my analysis of the technical indicators, on-chain data, and macroeconomic factors, I see three potential scenarios playing out. each with its own probability and set of triggers. Scenario 1, the bearish breakdown, 60% probability. This is the most likely scenario in the current market environment. In this scenario, Bitcoin breaks below its 200-day EMA, which would confirm that the bull market is over and we're entering a bear phase. Ethereum breaks below its key support at $3,750, opening the door to a deeper correction. The price targets for this scenario are $102,000 to $100,000 for Bitcoin and $3,650 to $3,550 for Ethereum. In an extreme case, if panic really sets in, we could see Bitcoin drop all the way to $95,000. In this scenario, altcoins could see another 10 to 20% drop, with some of the more speculative tokens potentially losing 30 to 40% of their value. Scenario 2, the sideways chop, 25% probability. In this scenario, the market finds a temporary bottom at the current levels and enters a period of consolidation. Bitcoin would trade in a range between $105,000 and $110,000, and Ethereum would trade between $3,750 and $4,000. This would be a period of low volume, choppy price action as the market digests the recent losses and waits for a new catalyst. This scenario would likely play out over the weekend when trading volumes typically decline and there are fewer market-moving news events. In this scenario, we would see the fear and greed index stabilize around current levels, and the RSI would bounce around the oversold territory without making a decisive move in either direction. Scenario 3, the bullish reversal, 15% probability. This is the least likely scenario in the current environment, but it's not impossible. In this scenario, we see a sharp reversal to the upside triggered by a positive catalyst, such as a de-escalation of the trade war. This could happen if the US and China announce a temporary pause in tariff implementation or agree to resume negotiations. A surprise rate cut from the Fed, or even a strong signal that a rate cut is coming in November, could also trigger a bullish reversal. This scenario could also be triggered by a massive short squeeze, as the extremely negative funding rates suggest that the market is heavily short. If Bitcoin manages to reclaim $110,000 with strong volume, it could trigger a cascade of short covering that sends prices sharply higher. The price targets for this scenario are $115,000 to $120,000 for Bitcoin and $4,500 to $5,000 for Ethereum. However, I want to emphasize that this is a low probability scenario, and traders should not position themselves based on hope. Now let's talk about how to trade this market. The key here is risk management. This is not the time to be a hero and go all in on a position. This is not the time to use maximum leverage and bet the farm. This is the time to be a disciplined and strategic trader, to preserve your capital and to wait for high probability setups. For the conservative trader, your primary goal is capital preservation. In this environment, I would recommend being mostly in cash or stablecoins right now, at least 80% of your portfolio. Wait for a clear reversal signal before deploying significant capital. Set buy limit orders at major support levels, such as $102,000 for Bitcoin and $3,650 for Ethereum. Avoid shorting the market as the risk of a short squeeze is high. Focus on Bitcoin and Ethereum and avoid the more speculative altcoins. Your goal is to survive this downturn with your capital intact so that you can deploy it when the market turns. For the moderate risk trader, you're looking for a balanced approach between capital preservation and growth. I would recommend a mix of 50% cash, 30% range trading, and 20% long-term accumulation. You can trade the range in the sideways chop scenario, buying at support and selling at resistance. For example, if Bitcoin drops to $105,000, you could buy a small position with a stop loss below $104,000 and a take profit at $109,000. This gives you a risk-reward ratio of about 1 to 4, which is acceptable for range trading. You can also start to accumulate long-term positions in Bitcoin and Ethereum at these lower prices, using a dollar-cost averaging strategy. Be prepared to adjust your strategy quickly if the market breaks out of the range in either direction. For the aggressive trader, you're looking for maximum returns and you're willing to take on more risk to achieve them. You can consider shorting the market with tight stop losses, targeting the price levels in the bearish breakdown scenario. For example, if Bitcoin fails to reclaim $108,000, you could short with a stop loss at $109,000 and a target at $102,000. This gives you a risk-reward ratio of about 1 to 6, which is excellent for a short trade. However, you must use tight stops and be prepared to exit quickly if the trade goes against you. You should also be prepared to flip long on a confirmed reversal signal, as the potential for a short squeeze is high. Use leverage cautiously, no more than 3 times, and take profits quickly. This is a high-risk, high-reward strategy, so only attempt it if you are an experienced trader with a proven track record and strong emotional discipline. Here are the key technical triggers to watch for in the next 24 hours. Bullish triggers. Bitcoin reclaims $110,000 with strong volume, at least 50% above the average daily volume. Ethereum breaks above $4,000 resistance with conviction. Positive news on the US-China trade war, such as a tariff pause or resumption of negotiations. The Fed announces a rate cut or signals that a cut is coming soon. Major inflows into Bitcoin ETFs, reversing the recent outflow trend. A short squeeze triggered by extreme negative funding rates. The stock market, particularly the Nasdaq, rallies strongly, up 1.5% or more on the day. Bearish triggers. Bitcoin breaks below its 200-day EMA with a decisive close below $105,000. Ethereum falls below $3,750 support with high volume. Further escalation of the trade war, such as additional tariff announcements or retaliatory measures from China. Additional Bitcoin ETF outflows exceeding 3,000 BTC. The stock market continues declining with the Nasdaq down 1% or more. The liquidation cascade accelerates, with total liquidations exceeding $1.5 billion in 24 hours. The crypto market is at a critical crossroads. The next 24 hours will be crucial in determining the market's direction for the coming weeks and months. The macroeconomic headwinds are strong, with the US-China trade war creating uncertainty and the Fed's policy direction unclear. The technical picture is bearish, with Bitcoin at $105,929 testing critical support and Ethereum at $3,762.59 breaking below $4,000. The on-chain data shows institutional outflows and massive liquidations that have now reached $1.2 billion. However, the extreme fear in the market and the oversold conditions also create the potential for a powerful reversal. Markets often bottom when sentiment is at its worst, and the current level of fear could be a contrarian indicator that we're near a bottom. This is not a market for the faint of heart. It's a market for the informed, the disciplined, and the strategic. It's a market where you need to have a plan, stick to that plan, and not let emotions dictate your decisions. Fear and greed are the two most powerful emotions in trading, and they are both running rampant right now. The key is to remain calm, to analyze the data objectively, and to make rational decisions based on probabilities and risk-reward ratios. Remember, in times of extreme volatility, risk management is paramount. Don't let fear or greed dictate your decisions. Stick to your plan and trade what you see, not what you hope for. Use stop losses on every trade. Never risk more than 2 to 3% of your capital on a single position. Diversify your portfolio across different assets and strategies. And most importantly, preserve your capital so that you can fight another day. The crypto market has been through many cycles of boom and bust, and it has always emerged stronger on the other side. This correction, as painful as it is a natural part of the market cycle. It shakes out the weak hands, the over-leveraged speculators, and the tourists who are only in it for quick gains. It leaves behind the true believers, the long-term investors, and the strategic traders who understand that volatility is the price you pay for the potential of outsized returns. This is the time to separate yourself from the herd, to think independently, and to position yourself for the next bull market, whenever that may come. Thank you for joining me on Boni's Life. I hope this analysis has given you the clarity and the tools you need to navigate this challenging market environment. Don't forget to like, subscribe, and hit that notification bell so you don't miss our next deep dive into the world of finance. Share this video with your friends and fellow traders who need to hear this message. And remember, the best investment you can make is in your own education and understanding of the markets. Until next time, trade smart, Stay disciplined and stay safe.